Hello learners, welcome back to the channel. This is the channel where you will get the video lectures of accounts for grade plus 1, grade plus 2 commerce, BCom, Bachelors of Commerce, Masters of Commerce, and most importantly, all the commerce related government exams, whether it is SBA grade A or it is P triple SB junior auditor, P triple SB senior auditor, and other exams which are related to commerce. So please subscribe to the channel and let's begin with the class. Credited worth rupees 10,000. Right? So this is for interest on drawings. Then next accounting entry we will do for goodwill. So next is goodwill. When we talk about goodwill, goodwill is basically an intangible asset because goodwill is an intangible asset because it does not have any goodwill is an intangible asset. So when we talk about intangible asset, if it is realized in it could be realized in two forms. First is cash and then next is non-cash. These are the two ways in which goodwill can be realized. Suppose it is paid in cash. Now what will be the accounting entry? It would be cash account debited to realization account. Because the goodwill is realized in cash, so debit what comes in, we have already talked about the rule. So cash account debited to realization account. This is the one case. So we will record this and we will write being goodwill realized in cash worth rupees 20,000. So we'll write with 20,000. This is the one way to record the goodwill in the cash form. Next accounting entry we will do for goodwill when it is an intangible asset. One, it is an intangible asset, but when it is not realized in cash, it is realized through partner's capital account. The second entry, when goodwill not realized in cash. When it is not realized in cash, then the accounting entry would be, suppose it is through A's capital account. So A's capital account debited to the realization account. So suppose the amount is rupees 10,000 again. So we will record for 10,000. So we write the entry being A's capital account debited worth rupees 10,000. This is when goodwill is not realized in cash. Next, after goodwill, we have other things to note down. We have various types of reserves. When we talk about the reserves could be categorized into various parts. It could be asked in the form of MCQs about the capital reserve. So, there is capital reserve and there is revenue reserve. When we talk about capital reserve, if we talk about the nature of capital reserve, it is not to be given to a particular shareholder. The capital reserve is not for the shareholder. But when we talk about the revenue reserve, it is for the shareholder. When I mean this is for the shareholder, means it could be distributed or given to shareholder in one form or the other. Capital reserve, we don't have much examples, but in revenue reserve, one common example is of general reserve. General reserve which could be given, which could be distributed among the shareholders. Then when we talk about these two, we have shareholders fund. We have sinking reserve. After capital reserve and revenue reserve, the next type of reserve is sinking reserve. So when we talk about the sinking fund, so what is the sinking fund, or what is it is sinking fund? So point number 10. Sinking fund. This is the type of fund which could be used in case of lease and mine. Means we can talk about the sinking fund as that type of reserve which could be used for certain purposes. And first example is there of mines. Means any amount to be given for the purchase or purchase consideration for mines, it could be used there. Second, it could be used for lease. Suppose a certain property, lease of property. Suppose a certain property is there which is given on a lease. For that, sinking fund could be used. Next, we will talk about the ratios. When we talk about this chapter, ratios, you should consider that the ratios show about the financial aptness, we can say, of concern, and the ratios could be divided into four parts. First is the liquidity ratios. Then after that we have the After liquidity ratios, we have the solvency ratios. Then we have the activity ratios. And last we have the profitability ratios. So these are the types of ratios. All are there for a certain purpose, like liquidity ratios. Liquidity ratios tell the short-term financial position. So we will cover it one by one about these four ratios. Liquidity ratios, it tells about the short-term financial position of a concern, that is called as the liquidity ratios. So here are two parts. First is when we talk about liquidity ratios, we need to consider there are certain types, there are certain examples of these ratios. So first we have, when we talk about the liquidity ratio, one is the quick ratio, that has to be 1:1. Another type of ratio which is considered is called as the current ratio. So one is the current ratio. Current ratio is equal to current assets over current liabilities. And the ratio is 2:1, means current assets should be twice the amount of current liabilities. Next we have the quick ratio. So quick ratio is equals to quick assets over current liabilities. And this is 1:1. After considering these two ratios, we have an important question. Suppose the current ratio is given to us 2:1, and we are given the current assets rupees 20,000, and it is told to find out the current liability. So we'll use the formula current assets over current liabilities is equals to 2:1 is equals to 20,000, and here are the current liabilities. So similarly we will subtract it and we will get 10,000 as current liabilities. The amounts could be changed and the question could be made to a difficult level, but the basic concern is we have to calculate the current liabilities. After this, after the liquidity ratios, there are two types of liquidity ratios. Next we have with us is the solvency ratios. So that was for short term, and solvency ratios are for a long time. To know the long term stability of concern. To know the long term stability, we have long term solvency ratios. So when we talk about the solvency ratios, it is to be calculated. One is the debt equity ratio, another is debt to total funds ratio, next is interest coverage ratio. When we talk about debt equity ratio, we have debt equity ratio. Debt equity ratio could be calculated long term debt over shareholders fund. This is debt equity ratio. Then we have debt to total funds ratio. Debt to total funds ratio. Here we have long term debt is to be divided by capital employed. So I will tell you the basic difference between shareholders fund and capital employed. There is a difference between shareholders fund and capital employed. In shareholders fund, only equity and preference shares are included, and in capital employed, we will include other things as well. So this is the basic difference which you should know among the shareholders fund and capital employed. Next we have interest coverage ratio. We call it ICR, interest coverage ratio. Interest coverage ratio could be calculated on one basis, that is net profit before interest and taxes. Net profit before interest and taxes divided by interest on long-term debt. So this is the ICR, interest coverage ratio. You should know the all theory first of all in these lectures, then only we will calculate the numericals, because numericals are also very much important. After this is the basically solvency ratios. After solvency ratios, we have activity ratios. After the solvency ratios, we will talk about the activity ratios.